Hey everyone, welcome back to Corporate Decoder, where we simplify Wall Street jargon. And today we are diving into Carlisle Companies Inc.'s latest filing, and let's just say they are not shy about it. So what's the big news? Well, Carlisle Companies, a company you might know for its diverse industrial products, has just dropped a report detailing its recent financial moves. And it looks like they've been busy raising a ton of cash. This filing specifically talks about a major event that happened on August 20th of this year. Carlisle Companies Incorporated, or the company as they call themselves here, basically borrowed a cool $1 billion through a public offering of new notes, which is like selling bonds to investors. They issued two types of these notes. The first batch is worth $500 million, and these will be paid back in 2035. The interest rate on these is 5.250%. Think of this as taking out a big loan that lasts for about 10 years. Then they have another $500 million in notes, but these are due a bit later in 2040. These have a slightly higher interest rate of 5.550%, meaning they're paying a bit more for this longer term borrowing. So $500 million due in 2040, all for a cool bill raising. Now, what governs these loans is a document called an indenture. The one they're using is actually pretty old, dating all the way back to January 1997. It's been updated over the years, but the core agreement allows them to issue these kinds of debt. US Bank Trust Company is acting as the trustee, basically the middleman, making sure everything goes as planned with the loan. How do the payments work? Well, they'll be paying interest twice a year on March 15th and September 15th. The first interest payment is coming up on March 15th of next year, 2026. The actual money they borrowed, the principal for the 2035 notes, is due back on September 15th, 2035. And for the 2040 notes, that big repayment happens on September 15th, 2040. So they have quite a bit of time to pay back the 2040 notes. That's a 16-year loan at this point. It's important to know that these notes are considered senior unsecured debt. This basically means they are not backed by any specific assets. If the company were to hit hard times, these bondholders get paid back before those owning things like stock. But after those who have loans secured by specific company property, they rank equally with other similar debts the company might have. Now, as with most big loans, there are some rules that Carlisle has to follow. These are called negative restrictions. For instance, they can't just go out and borrow a ton of money secured by their valuable assets, or sell off a major operating part of the company and then lease it back from the new owner without potentially breaching these agreements. These are pretty standard things to keep the lenders feeling secure that the company won't do anything to jeopardize its ability to repay. There's also a cool option for Carlisle. They can actually pay back these loans early. For the 2035 notes, they can do this anytime before June 15, 2035, which is about 3 months before the official maturity date. If they do this, they have to pay back the loan at what's called the make-whole price. This sounds a little scary, but it basically means they pay back the full amount owed plus any interest they would have paid if the loan ran its full course, minus some adjustments designed to make the lender whole as if the original deal hadn't been cut short. And for repayment at or after those dates, June 15th for the 25 notes and June 15th for the 2040 notes, they can actually redeem them at face value, which is called par plus any interest that's already due but hasn't been paid yet. This is a much simpler way to pay back the loan. This whole deal, this offering of notes, was officially launched with a document called a prospectus supplement that came out on August 13th and was filed with the Securities and Exchange Commission, the SEC, a couple of days later. This supplement works with a main prospectus, which is like the master document that has all the general information about the company's ability to issue stocks and bonds, and that was filed back in March of 2024. If you're really into the nitty-gritty details of these notes, the actual paperwork for what those 2035 and 2040 notes look like are attached to this filing as exhibits. Now, there's a section that really spells out what this means financially for Carlisle. It directly addresses the creation of these new financial obligations. It's basically a formal way of saying, hey, we just took on $1 billion worth of debt. Under another item, they talk about other related events. This is where they mention the deal makers. Carlisle signed an underwriting agreement and what they call a pricing agreement on August 13th with some big players in the investment banking world, Goldman Sachs, JP Morgan Securities, and Truist Securities. These firms acted as the representatives for the group of underwriters who helped sell these notes to investors. This underwriting agreement, which is essentially the contract for selling the bonds, lays out all the promises each side is making. Carlisle promises certain things about its business and financial health, and the underwriters promise to use their best efforts to sell the notes. There are also clauses about what happens if things go wrong, like who covers costs if there's a lawsuit. This very agreement, the underwriting agreement and the associated pricing agreement, which really nails down the fine print of the deal, is also included as an exhibit. And remember that master indenture from 1997 we talked about. That's Exhibit 4.1. It's a massive document that sets the stage for all the debt Carlisle might issue. They also included an opinion from a law firm, McGuire Woods LL. This is a legal sign-off, essentially saying that the notes have been issued correctly and are valid obligations of the company. And with that legal opinion comes a consent from the law firm McGuire Woods LT, allowing their opinion to be used in this public filing. Finally, there's Exhibit 104, which is a cover page in a special data format called Inline XBRL. This is designed to make financial information easily readable by computer programs, which helps with transparency and analysis. So what's my take on all this borrowing? Carlisle Companies is clearly making a significant move to fund its operations or expansion. Raising $1 billion signals confidence in their future prospects, enough to convince investors to lend them such a large sum. The interest rates, while not insignificant, seem reasonable for the current market, especially for the longer term notes. They're paying a premium for that extended period of borrowing. The key thing to watch here is how they use this borrowed money. Are they investing in growth, like new product lines or acquisitions? If they are, this debt could fuel significant future returns. However, if that money is simply used to cover existing operations or to pay off other debts without a clear growth strategy, then $1 billion in new debt could become a burden. The negative restrictions are important because they limit the company's flexibility, and if they need to sell assets or take on secured debt down the line, they'll have to be very careful. It's a calculated move and a pretty standard one for large corporations looking to manage their capital structure. The fact that they're using an established trustee and familiar legal agreements suggests a well-planned and executed financial maneuver. It shows they are prioritizing a steady approach supported by experienced financial partners. The success of this strategy hinges entirely on their ability to generate returns that comfortably outweigh the cost of this debt. Alright, that's our breakdown of Carlisle Companies' latest financial maneuvers. What's your take on this significant borrowing? Does it point to exciting growth ahead or potential financial strain? Drop your thoughts in the comments below. If you found this deep dive valuable, please hit that like button and subscribe to Corporate Decoder for more insights. And don't forget to join our Discord community linked in the description for more discussions and to connect with fellow analysts. Thanks for watching, and we'll see you next time.